Welcome everyone to episode 2 of the Capital and Context podcast with myself, Mark Insley, and Samuel Hallett again with me here in the studio.
Thanks for having me.
No worries. Welcome back. This week we are going to speak about US equities, which for those listening that sort of wonder what does that cover. I think, Sam, if we just start off with a sort of more simple answer of what would be covered on a podcast of US equities, what sort of types of companies and things does that
sure.
cover?
So obviously, US equities covers the biggest equity market in the world. When you're looking at a worldwide index of equities, the US comprises well over 40% of that. So as a standalone element, that is very big. But in terms of kind of companies, you got, for example, your traditional industrial names, so your General Motors, Ford, but even slightly older tech firms like, say, for example, Nvidia. I know people are talking a lot more about Nvidia these days, but Nvidia's been around for decades and decades. But you've also got Microsoft, Apple. We're talking the really big boys are in this index, really. Yeah. Well, in this market, rather.
And we talk also, it could be small cap companies and things as well. So when we talk US equities for the context of this, it could be covering lots of different areas.
Absolutely. It's one thing that's quite perhaps interesting from our job's perspective is when people are talking smaller US companies are actually companies that in the UK might be creeping up still into the FTSE 100.
True.
So some of these small cap US companies are still not necessarily small names, but yeah, they can of course go much smaller than that.
I remember you telling me that before. The mid cap is technically those companies in the US mid cap are bigger than the majority of companies in the FTSE 100.
You've got so for example, Domino's Pizza, believe it or not, it actually sits in the small mid cap space. Yeah, if it was over here, that would certainly be a FTSE 100 company.
Yeah. Okay. So I think last week it was you were saying the US market story is complex. So could you expand for viewers what you mean by that?
Yeah, so it certainly is complex. So on the one hand, obviously coming 2025, big story was tariffs, and that impacts obviously such a large sector as the US in various different ways. So from the perspective of the services companies, so an awful lot of how in Europe at least, how we interact with US companies is through the services. So for example, Zoom, Microsoft, etc. These services aren't necessarily selling raw goods, so they're not impacted by the tariffs last year, but yet they've had a little bit of being able to expand their profit margins because of how things have got more expensive generally, and therefore they can afford to bring up that amount that they're selling their products for from a perceived affordability perspective. Going to other ends of the market, you might say, for example, US automotive industry. Automotive industry is very, very global. So when we end up with tariffs and those kind of things, it really impacts those industries really quite hard. But when we come into this year, well, we're going to a little bit further. We've got a combination of politics domestically, but also we've got a few like tax reasons, etc., which is why 2026 looks pretty good.
Okay. So, I mean, I guess with the US as well, it's elements of potentially always being complex as well as short-term complex. But yeah, from all our meetings, it always is and always will be a dominating theme, right? Because it's so important, especially to multi-asset portfolios. Yeah. So S&P 500 again is probably the potentially now the best known US market index. Probably arguably the Dow was 50 years ago, but I think anything press wise and things, and anyone to looking to invest in the US is probably gonna go towards S&P 500 as their sort of bucket of choice. Where would you view the S&P 500 right now? And would you say it's expensive? Is it a market that's attractive to you?
It depends through the context in which you look at it. So if you were to look at it purely from either a backwards looking 12 months perspective or forward looking 12 months perspective on like multiples of earnings, so an awful lot for people who don't know who are tuning in, one of like the foundation ways that we look at valuation of companies is how many times the current year's earnings or possibly backwards looking earnings is that company trading off of. So if it's got say $5 per share worth of earnings and it's got trading on 20 times, then its share price is currently $100 per share, just as an example. But the if you look at it on that very short kind of basis, just looking forwards and backwards 12 months, yeah, it looks expensive. The problem is, though, with that is that you're not looking at the longer term story. And when you look at the revenue growth that is going on in the AI space, obviously it's such a big space, we've got to do a bigger conversation on this at some point. But when you look at the revenue growth and how the earnings are changing within that space, look at Nvidia's earnings are quarter on quarter just going through the roof. So therefore, you've got to look 2 or so years out. On a cyclically adjusted basis, things actually look okay. The current median S&P 500 stock, so once you start moving out of the Magnificent Seven space, so Magnificent Seven, again, for those who aren't aware, is like your Nvidia and those big AI names.
Meta
as you said, like Meta, Facebook, etc. That's kind of trading kind of fair value where you'd expect it. So, and the other problem as well is, yes, the S&P 500 could be seen as a little bit expensive, but so is pretty much everything in the world at the moment. Relative value is kind of, as multi-asset managers at the moment, we're having to go off of relative value rather than, oh, that's definitely cheap, let's buy that. It's like, what's cheaper than everything else at the moment?
Yeah, okay. And maybe, again, just to bring these podcasts back to, to holdings in portfolios and things like that. And I don't want to put you on the spot with this, but whilst we're on US, could you perhaps just talk a little bit more about I touched on it earlier, if we just to not be talking about the Magnificent Seven as often is done in podcasts. Is there a sort of US small cap fund that you particularly like, or something that we hold in the portfolios at the minute, that why we hold it, or if we don't hold it, just talk a little bit more about that small cap space with a fun focus, please.
Yeah, absolutely. So first of all, what I'll start saying is just at the large cap level, we tend to hold passive. And the reason for that is there's so many analysts working on that space, is everything tends to be priced to perfection to a degree. Yeah. It's hard to find an idea that someone hasn't thought of. So we tend not to spend extra cost of clients' portfolios. After all, in our higher risk portfolios, US equities makes anything up to around about 50% of a portfolio. It's a large amount.
And what difference can that make for holders? I guess an active fund can be anything from 0.75% upwards versus
actives have got a little bit cheaper these days. Through our negotiations with the fund houses, we've actually we've exited it now, but last year we were in an active large cap US position, which was only 0.17%, which from an active perspective is actually really good. Very good. But when you move down into the smaller cap space, you don't have as many analysts researching the company. And not just that, it's a huge space. Just the major index that everyone kind of tracks in this space is the Russell 2500. Okay. You get the idea from the number. That's how many companies that everyone would have to research. So those little ideas are more common for an active manager to find. So within this space, we actually use the T row US smaller companies. Okay. And the reason for that is the smaller company space, around about 90% of that index doesn't actually generate positive earnings. So therefore, we want someone who's very much looking for quality. and not just going off of what happens with these companies that don't earn positive money, is that they become in essence a credit play in some weird way. Like as high yield credit gets cheaper, they tend to do better, whereas these are concentrating more on the companies that are good quality, they're producing good income, and yet still have room to grow further.
So that
and that's
T Rowe
something-
is a active smaller cap fund.
Yeah, absolutely. And T Rowe are very much a US orientated fund house, so that's very much a specialism area.
Okay. And view of holding that, is that something you've held? You mentioned you hold it. Is that something? Has that been a long term hold? What's the plans for that in the next sort of 6 to 12 months?
Yeah, sure. So going back into the US small cap space has actually been something that's only circa 3-4 months old. It's not something that we held for a while, just because of as credit yields 2022 went up an awful lot.
Mm-hmm.
It put a lot of pressure onto that space. Whereas now credits it's certainly very tight now compared to sovereigns, which we'll cover in a later episode. So it's actually something that we've only gone back into about 3 or 4 months ago. As I said, when we're going into a space, we wanted to be active. So there's always a little bit of a degree of course, we're managing funds for all sectors all the time, but making sure we've got the right one for the environment.
Yeah.
2022, when credit got rather expensive in terms of yield, it became a bit of an area that really ended up impacting that small company space, as I mentioned.
Yeah.
And now I think things are turning around as credit's got a little bit cheaper. Not just that, with the US large cap being so expensive, people are looking for new places to deploy their capital. This is one of those kind of places that seems very much like the next obvious place for an awful lot of people to put their money domestically next.
Yeah.
And not just that, smaller companies does tend to get an end of cycle outperformance go on there.
Yeah.
But also we've got a load of tax reasons that should really, really help US domestic economy. So we've got within the One Big Beautiful Bill that happened last year, which was the big, massive, sweeping tax reform, amongst other things, that went through the various governmental branches last year. Some of those tax reforms were actually retrospective. So right now, we've got a load of US companies and US people who are putting in their tax returns who have actually definitely have overpaid tax this year. And the median tax refund is going to be over $2,000, expectations are. Yeah. So everyone's going to get a $2,000 check. US tends to be an area that consumers like to spend. So that's going to get put into the economy. Could potentially be a little bit of an inflation uplift there as well, which is something to keep an eye on, but not necessarily relevant to this. But there's various reasons also that help within that bill US companies as well deploy capital. That should help that whole economy turn really, really well this year. And not just that, we've also got the US midterm elections at the end of the year, which has a political element.
Great. So as a portfolio manager should do, they go back to a fund in their portfolio and they know about, and clearly it's a fund you have an affiliation with. For those of us that are listening as wannabe portfolio managers and things, and apologies if it can just be a broad answer, but taking our portfolio 5, that is our highest risk portfolio, which again I'm partly plucking a number but for calculations purposes. Let's say we hold 42% America in that. So as you've already told viewers, America is always going to dominate portfolios, irrelevant of whether it's our portfolio 1 or portfolio 5. So in our portfolio 5, let's say we hold 42% in America. What sort of range would that small cap fund hold of that 42%? So, as someone that has to make these decisions, where would you be in the, or what percent out of 100 of that 42% does a small cap hold at the minute? And probably more the probing question is in your head, where would be the maximum the maximum holding of that 42%, you may move to as a portfolio manager without a constraint.
So at the moment, the current range that, based on current environment, would be somewhere between 10 and 20%. And the reason for that is small cap, if you take the market as a whole, doesn't actually make up a huge percentage of that wider sector. So you don't need to have a very large allocation to be overweight the index, and that's what we're about. Really, we're kind of relativistic compared to benchmarks, etc. We seek to outperform benchmarks, so of course that's going to be our starting point from where we go to. Absolute maximum, an extreme version, I think we'd go to is 40%, and the reason why I wouldn't go further than that is smaller companies tend to have more volatility. That volatility isn't necessarily a bad thing. Volatility can, as well as being downward, volatility can be going up 10 times, kind of thing. But we have to be aware of the volatility of the overall portfolio for obvious reasons, and therefore I wouldn't want to go above that point. You'd have to have real conviction to go up to that point, I'd say. Similar for
real
other
conviction,
things.
agreed. Yeah. And as I say, in our investment strategy and thesis, what sort of Sam is sort of talking about there is that, we ourselves are benchmarking ourselves in every sector that we're invested in. So if our 9 benchmark constituents are very conservative and only hold companies in those S&P 500, for Sam to go 40% in small cap is him taking quite a big call just in the US alone away from our benchmark, which ultimately we're paid to do. But yes, I think that answered the question. I think that answered the question well, and will help others where in their portfolio management and construction.
I think the quick thing to add on to that is it's about being active responsibly. I think that's the key thing. Obviously, we have a fiduciary duty, and that responsibility with how we're active is really important.
Yeah. And I quite like the way that I'm driving this session away from, over talked about US government fundamentals. So if we can kind of stay on the theme of asset allocation in the US market, because I personally think it's a more interesting episode talking a bit about this. So, and again, from my own experience of being sat in Sam's shoes, one of the things that has been a talking point for the last 10 years 20 years for myself, like it's there. I mean, to be honest, I don't think it was such a big talking point 20 years ago. I think the flip point was probably 2013 2014 when we saw a mass move from what was £2.10 on the dollar. Showing our age now.
I was going to say, I recall we're getting old now. Was very different.
And going right down to a range which for those of you on YouTube, definitely it contributed to the greys in my hair, where I think we went down to was it £1.08, £1.04, £1.05 intraday. So what's that from 210? That was a 50-60% swing in currency that we've dealt with whilst working together on the CBAM portfolio. So just some context there, that in America and in portfolio management, we have the dreaded hedging of being hedged US equities currency wise or unhedged. So I guess that's my prompt, and take that where you want in terms of educating viewers on the role that it plays and where you're positioned at the minute and why.
It's interesting. Before we started this, I actually had a conversation with one of our colleagues and was saying that our benchmark constituents largely, and our peers from what we know, obviously people try to keep onto their secrets as best as possible, but from what we understand, the vast majority of our peers don't hedge US equities, which I think we are in a slightly different mindset, in the sense that actually by not hedging, you're introducing FX risk into portfolios. And I find that in some way a little bit odd. But so we are happy to use hedging in our P portfolios. Our portfolios have a more a simplified remit in the sense that they don't have hedging and they stay passive where possible. At the moment, we are 20% dollar hedged, cable hedged, which is working in our favor. If you are listening this week, we've had for Japan, US yen intervention, and I think as we speak right now, we're something like $1.37.6 to the pound, where we started off somewhere like $1.31. We've had in the space of a week quite an FX swing. So about 20% hedged, will be certainly an alpha component for us.
Why are we not 50% hedged? Joking.
No, I'm happy to say about it. So
no, we've learned a lot about this trade in the past, right?
So I think 50% is the most we would go to. If you look at, again, don't really want to go into other areas, but you'd probably say at where it is right now, about that 137.6 is perhaps a little bit actually gone too far. And not just that, all these intervention events typically end up in the long term reverting back to where it would have been anyway, so might actually undo some of that because it seems like a nice point to come off. And not just that, you go back to, I'm just trying to think, like pre-Brexit, we're like 140
undoing some
something.
of that would be Sam completely taking the hedged element of his US equity allocation and going back to what we believe the benchmark is, which is completely unhedged, so just straight US equity funds where the price goes up or down based on the pound dollar conversion back for UK holders.
I'm not sure I'd go 0% hedged, but it certainly needs very quickly some research to work out whereabouts I would go, possibly halve it. But I think we're a little bit too far at moment 137. I'm trying to remember pre-Brexit, we're looking at stuff like
when we're struggling for topics in 10-11 weeks time, we'll do a whole we can do another whole episode and debate the history and stuff of that. So is there anything else you want to sort of say on that? But I think it sort of again relates itself well to the topic of US equities and gives viewers insight to why it's important.
The thing I think
for any self-investors, again, you it's just something to look at in your decision. Do you want to just hold US equities for US equities? In doing that, you'll naturally be rewarded or unrewarded based on the pound dollar movement. There, in lots of markets, there isn't the option to go and pick a fund that has a hedged version of that fund. So if you're someone really into that or using portfolio management as a learning tool for self-investing even, then I think the takeaway is someone, Sam, managing 500 million of assets is that something he's using in his portfolio allocation specifically for US equities. So I think that was my takeaway point. But maybe we'll do a whole session on the long history of that. Great. So I think we've done a lot on sort of some technicalities in asset allocation. Policy backdrop for 2026 forward looking. Let's talk a little bit about that and bring us back to some sort of more economic views and things rather than asset allocation driven ideas.
So I think the thing that we have learned, I think we knew already going into last year, but it's certainly solidified now, is that tariff risk is real. How much they stick though, and how much the taco trade ends up kind of winning the argument is a whole episode practically in itself. But sorry, I thought you were about to say something.
No.
I think the thing that we've learned there is that, looking back at 2025, but it's solidified now and looking forward, is that the tariff risk is real, and they can change on a whim. How much they stick though, and how much the taco trade kind of happens is a different kettle of fish. Tariffs increasing is typically very good for domestic producers. Obviously, you think about it, otherwise you're going to have to pay to import something, despite what the US government says that other companies pay for the tariffs. No, it's the people who import them. And that's kind of another reason why we're looking at that T row US smallers fund, is because that's one thing that they do very well. But also looking towards the end of this year is that you have the US midterm elections. So you probably find at the moment suggests that Republicans aren't doing too great in the lead up to those. Can guarantee they're going to throw the kitchen sink at every single possible reason to make everyone have the feel good factor.
Yeah.
So be expected to find some things maybe in the next few months, because you've got to give them time to feed through into people's pockets. As I said, we've already had, last year's tax changes, which has got to give people a large tax. Keeps on calling it the tariff dividend, but it's just a tax rebate. But still, people go out and spend that. Circular movements in the economy. There's good reasons for it this year, not just that. AI, I will touch briefly because, as we said, this is something that we could go into depth for long. It's that AI, this is the year probably that the capital spent on building out AI finally starts eating away at these big hyperscalers, as they're called, free cash flow. But the scale of a build out, we're talking trillions per year kind of size now. And so whilst things aren't showing red flags in that space yet, it's still going to produce a lot of growth in the economy. The US economy last year, actually, when you strip out AI, wasn't that great. The AI spend is really pushing things along. So at the moment, 2026 is actually lined up to be a decent year. I think the thing to keep an eye on is possibly the years after that, though. But that's always our job.
Okay, and I guess so. Yeah, sort of fairly positive view for the rest of 2026. As we know, it only takes one event to happen. We've spoken about geopolitics in other episodes, and if AI doesn't prop up, or if there is an AI bubble that suddenly comes in, what do you think? Is there anyone on the kind of like recessionary talk or anything that could drive the US into recession? Is that something that's being spoken about in markets at the minute? And how are you thinking about that, or are you just pushing it out for another 6 months and you're thinking?
I think so. There's things to keep an eye on at the moment, and as is often the case for these kind of things, the canary in the coal mine will be the credit markets. And the first of those, the canary in the coal mine, so to speak, is the private credit space. Now, in the US, over here in the UK, private credit isn't something that's necessarily as easy to access for retail investors. You might come across one or two investment trusts off the top of my mind. But in the US, you have these more, there's a special legal structure for basically you being able to buy companies that hold private credit, as in the credit elements from private equity.
Yeah.
And throughout towards the end of last year, those were trading at a discount of 10% to NAV, just because of people very much seeing a lot of caution needed in this space. Obviously, private equity tends to be the more speculative parts of the market. And it's those parts that are probably more exposed to the more speculative parts of the AI build out, parts that, building data centers that aren't necessarily in the best locations and things like that. So it's when those things start to fail, those will be the markers for us to go, okay, let's keep an eye on what's going on here. Okay. People very much keep an eye up on jobs at the moment, but jobs in the US, the unemployment is growing steadily, but not alarmingly. And the earnings elsewhere is helping keeping the economy going. But again, it's something to keep an eye on.
I think our next episode we will talk more on credit, because I think it's such a under discussed area, yet something that we've done really, really well in for extended period, have very strong managers in that space. So I think I'm going to I think next week's episode we'll talk about that if that's all right.
Absolutely.
To save anything further on that. Mr. Producer, how are we doing time wise?
Yeah, good. Is that episode 1?
No, I've got one bit more to talk about.
Yeah, batteries on 65%.
Are we in the 20 minutes or?
Oh, time wise, good question.
To be fair, we've restarted a couple of
No,
minutes.
you're 31.
Okay, fine, and I'll wrap this up.
Yep.
So yeah, I really look forward to an episode next week talking about credit, because it is a strong area for us and something under spoke about. So in an effort to try and keep these to half an hour, but wanting to kind of end for our target audience, if I could just have a 1 to 2 minute wrap maximum on whether it's our Ascot Wealth Management advisors or other financial advisors listening into this, would be great just to get a 1 to 2 minute wrap of how you would be talking about the US and its role in our Cape Berkshire portfolios at the minute, and if that's all right as the final thing for today.
Yeah, sure. So we're keeping our exposure to the growth elements of the market very much through that passive. We hold the Fidelity Index US and S&P 500 for the hedge version in that space. So that keeps very much our Mag 7 and all of those kind of elements going on there. And then, but I think you might see a little bit more of a value play starting to play in, just because of going back to credit again, that tail end is getting a bit more expensive, and that affects the growth story for other parts of the market. So that is very much helped by how T. Rowe are doing the US smallers.
Yeah.
So there's that element. 2026 should be a good year. Keep an eye out though for let's call them the amber flags that are there. They're very important to keep an eye out on. But if you're not going to put money into the US this year, there's probably one other area that I would look at, which is going to be from a broad index perspective, emerging markets, which we would definitely, I think, need to do in a couple of weeks' time.
Yeah. Okay. Well, hopefully, thank you, Sam. Hopefully that gives people an insight to the beast that is the US equity market, which was the theme of today's session. Hopefully we put in some useful snippets there on portfolio construction and the role that different elements of that US equity space can play in portfolio construction, and how we manage that ourselves here at Cape Berkshire Asset Management. So yeah, thank you again for your time, Sam. And we'll be back next week with an episode, by the sounds of it, on credit. So I very much look forward to that. So yeah, thanks, Sam.
Thank you.